US gold reserves now make up around 2% of the nation's outstanding treasury, down from over 17% in the 1970s and nearly 40% in the 1940s. Gold is now valued at about $25,000 at 17% and $50,000 per ounce at 40%. I'm not suggesting that liquidity providers don't think the demand for gold will slow down anytime soon. It would be far preferable to revalue gold sooner rather than later, which puts the Fed staff that is in charge of the 8,133 tons of US Treasury gold in a precarious position. Now, Mohamed El-Erian, a highly regarded individual, has noticed that, for the first time since 1996, foreign central banks now hold more gold after the European Central Bank, ECB, declared in June that gold had surpassed the euro as a worldwide reserve asset. A new period where gold once again serves as the foundation for the value of money might be ushered in by an unexpected revaluation by the US, China, or both. It would challenge preconceived notions about the yuan, the dollar, and what financial security actually means. The 260 million ounces of gold that the US Treasury is said to hold are now valued at around $11 billion. They would be worth about $936 billion at today's prices, which is relatively small in comparison to the $37 trillion government debt. A potential revaluation to at least $20,000 per ounce is suggested by certain analysts. It is a mistake to be skeptical of a revaluation of US gold. Andrew Maguire emphasizes that the first indication that led central banks to exchange depreciating fiat for gold at any price was the Bank for International Settlements Tier 1 reclassification. Since then, gold has increased by $2,000, therefore a US devaluation makes sense, he says. The world monetary system is at a turning point. According to Andrew Maguire, China is subtly assuming gold convertibility and challenging the dollar's hegemony by implementing Basel III compliant yuan gold pricing. China is now on the defensive economically as a result of rising trade tensions with the US. This has emerged as a significant factor influencing the price of gold in 2025, and it is anticipated that this trend will continue in the years to come. A thorough audit of US Treasury gold is being demanded due to the possibility of a gold revaluation or the revelation of far bigger Chinese gold stockpiles than publicly declared. This could reveal a significant secret. Andrew Maguire claims that a bid-only market will be compelled if the White House delays, demonstrating that the Fed has lost authority. To ensure you don't miss a moment when truth meets the market, click the bell symbol and hit the subscribe button before we get into Andrew Maguire's insightful observations from his most recent interview. Let's begin. The pessimism around the revaluation of the US gold market is natural, as we experienced similar skepticism when individuals questioned if the Bank of International Settlements would revalue gold as a first-year high-quality liquid commodity. I will thus review and update the gold revaluation footprints that we are now observing, as well as the most likely dollar gold price projections. I'll now additionally offer some reasonable silver goals at the conclusion of the year. Given that the majority of our information is filtered through the biggest liquidity sources or physical liquidity providers, they believe that gold and silver are significantly discounted in comparison to when they spiked to all-time highs months ago. Let's begin with gold then. The price of gold in dollars has increased by $2,000 per ounce just 33 months after the Bank of International Settlements' pivotal moment, when they revalued gold as a first-tier high-quality liquid commodity, sparked a rush by central banks throughout the world to exchange fiat currency assets for real gold. Gold has therefore averaged a very quiet, covert, unrelenting $60 per ounce price increase after netting out the intra-month volatility of the legacy market. The legacy paper market has reached an unmaintainable divergence inflection point because to the unrelenting demand for gold, which can only be addressed by a major bid-only margin call or a US revaluation of Treasury gold prices. After the Bank of International Settlements revalued gold as a first-tier high-quality liquid asset on January 1st, 2023, the covert gold revaluation process began. And now that global physical exchanges are sufficiently liquid to benchmark a real supply-demand gold bullion price outside the CME LBMA ring fence, it has gained enough momentum to force the US revaluation of Treasury gold is required. And we will examine those footprints in some way. Additionally, as we have been pointing out, the price of gold in all fiat currencies other than the dollar has surged to record highs. The actual game changer, however, is that China removed the gloves as soon as the price of one gold completely complied with Basel III, as we have been concentrating on. Now, the mainstream media still ignores this. These analysts attempt to create appropriate news releases, interest rate drivers, and other things that have a significant impact on paper market participants, but they totally overlook the central bank's underlying competition to exchange dollars and related fiat currencies, the entire spectrum of fiat currencies, for actual gold. Here's the secret though. They are acquiring at any cost, regardless of how much it is. Additionally, Beijing is quietly taking on the role of gold convertibility, which is the ease of hedging the price of the yuan against all other foreign exchange currencies, bonds, etc., as the Basel III compliant price of yuan-backed gold is benchmarked through an expanding network of physically backed SGE exchanges that face the West. As a result, the PBOC is quickly overtaking the dollar as the dominant currency in the world, which will eventually force the last remaining Basel III global central bank to comply and force a devaluation of the gold price. The mainstream media hasn't paid much attention to the fact that it allows the PBOC to directly benchmark physical gold against US treasuries, opening up vaulted bullion for use as finance collateral across the BRICS system and against the West. Gold is now flooding into these gold vaults facing West. Simply said, this gold is exchanged entirely outside of the legacy system in vaults supported by UN gold that complies with Basel III. The vaults are where the gold stays. Because of this, when it moves, there is neither dilution nor volatility. The SGE gold price is also easily interchangeable with Western central banks' underpriced legacy COMEX exchange gold, as we summarized in our most recent episode. This means that the gold is being depleted and every central bank in the world is racing to exchange more rapidly depreciating dollars to purchase the same amount of gold. The White House now realizes that foreign central banks are attacking US Treasury gold once more, just as they did when Rick Nixon took away gold's convertibility to the dollar in 1971. In other words, the Fed has totally hijacked the single remaining weapon in its arsenal of strategies for suppressing the price of gold. Every ounce will be depleted if those prices don't start to represent a true physical supply and demand price. The fact that Treasury Secretary Besant is now calling for a comprehensive Fed examination that covers the 8,133 tons of Treasury gold that the Fed is stick handling is no accident. Well, we discussed it a long time ago. It's gone. What was happening appears to have slipped beneath the radar. It is a top priority. This morning, Bloomberg was even discussing that. Thus, it is a top priority. In addition to thoroughly inspecting every vault, this would be the first fully trusted audit to reveal the amount of duplicate ownership claims on US Treasury gold. Remember, a large portion of it was loaned out. This needs to be finished before the US Gold GRA account, also known as the Gold Revaluation account, may be marked down from the current price of $42 or $8 billion to the genuine market value of $1 trillion. It only takes a mouse click to go from 8 billion to a trillion. Naturally, the revaluation process itself would push gold prices well above their current levels, creating a strong buffer for the next time. There won't be enough bullion to fulfill delivery obligations if the White House doesn't act quickly to revalue. This might lead to a force majeure situation, which would push world prices into a bid-only state and force the Fed to start taking prices at much higher levels. They can now print their way out of it, but the cost will increase. In 2017, Germany's unsuccessful attempt to repatriate gold revealed a worldwide scam. According to Andrew Maguire, the system was severely lacking in physical gold because the bars that were returned from the New York Fed were not the originals. The Fed is currently short physical gold, while central banks are long due to the disruptions in the LBMA and COMEX paper markets. There are obvious signs of an impending revaluation of US gold as big bullion banks cover their derivative bets. The possible reappraisal of US Treasury gold is more than merely a change in accounting. It denotes a thorough re-evaluation of gold's place in the contemporary monetary system. Policymakers are increasingly looking at non-traditional ways to deal with budgetary issues as global financial pressures increase and conventional monetary tools run their course. The Federal Reserve's own study, Notes on International Reserve Revaluations, indicate that the idea is being given careful thought despite the lack of official confirmation. Now, let's resume the interview. The Fed denied the German Bundesbank access to the New York Fed vault's holdings in February 2023. As a result, the Bundesbank requested that the first 300 tons of the 1,350 tons that they had placed following World War II be repatriated right away. These were numbered bars, and a lot of it was in the 1950s and 1960s, but after World War II. This is in contrast to saying, okay, we'll fly these 300 tons out when asked. Technically, it's a T+0 deliverable. It's in the vault, really. The vault is where it should be. You should be able to simply transfer it or have it safely transported into the airport from a Brinks or Loomis truck. Therefore, it is typical for you to be 12 days. We observe that 25-ton amounts of this type of silver are shipped. So, in reality, 12 flights weighing 25 tons ought to have completed it. However, it was discussing a delivery method that would take 2,555 days and 7 years. This is absurd. The records exist, but it's not believable. In fact, that's precisely what they hope to accomplish. The CME LBMA cartel was so lacking in gold that this revealed it. They were caught off guard. It was a delivery default, the first central bank delivery default. It was a big red signal that all of the US Treasury gold assets, whether they were audited or not, were probably double counted or somewhat rehypothecated. Additionally, these bars were found to be different from the ones that were first deposited, even though the Fed was humiliated and rushed to shorten the time frame for repatriating German gold when it finally arrived in Germany. In actuality, the assortment of bars contained recently struck bars combined with 22-karat milk gold from the 1930s. A shell game shuffle was used to repay the original Bundesbank bars, further demonstrating that they had been sold. Let's now examine the charts. I'm going to concentrate on this circle right here while this fast is being played out. It was no accident that on April 1st, at precisely the same time, the LBMA, ABN AMRO Bank, wrote a letter to one of our clients informing them that their requests for bullion redemptions would need to be paid in cash. We released this letter with their consent. We released this letter with the client's consent. Significant flaws in the LBMA's capacity to deliver on their 100-to-1 leverage unallocated gold holdings were revealed as a result of the deluge of new physical delivery requests that followed. In actuality, a 2010 Reserve Bank of India study that discussed 98-to-1 was the one that was created. A hastily convened presidential conference with all of the big bullion banks was placed over the Easter weekend, which is exactly where the arrow is. This was followed by the start of a significant, legally mandated $600 gold intervention on Monday, April 8th. And the only way to describe it is that the gold market intervened to push the price down from $1,600 to about $1,000. As you can imagine, it came to an end on December 31st, 2015. These kinds of derivative gold market interventions were made possible by the introduction of the Settle COMEX gold exchange paper after Nixon decoupled gold from the dollar to prevent foreign central banks from redeeming physical gold against depreciating dollars. Last time, we discussed it in greater detail. In actuality, the COMEX was prepared to carry out the instructions on the box, specifically the capacity to produce as much paper gold as could be required to dilute and control the price of gold, as disclosed in the WikiLeaks letter of December 10, 1974. And there were many of them. However, the BIS short covered all 500 tons of their remaining derivative gold bets 1 month before to revaluing gold as a first-tier high-quality liquid asset on January 1st, 2023, as a result of these paper-driven COMEX LBMA operations. It's in your face. I bring this up now because the entire Western-backed, cash-settled CME LBMA unallocated gold market has broken at the important inflection point once more. However, because they have been compelled to become price takers, the COMEX price setting process is the true problem. The Fed is the only central bank that is short gold this time around, while all central banks, both sovereign and bullion banks, are long physical gold. We can now see that the Fed is being compelled to short cover due to the size of these underwater positions. Step by step, we may observe that.